First quarter was clearly impacted by a couple of one-offs, including number one, our 700 million legal provision.
We're sticking with the revenue outlook for the full year that we provided back in March of 26 to 27 billion euros. That's growth on last year and well ahead of where the market consensus is.
In terms of revenues, the most direct impact is the fact that we suspended the vast majority of our commercial activities in Russia. About 1% of Google revenues were from Russia.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Weaponizing energy, Russia cuts gas supplies to Poland and Bulgaria. Gas prices soar. The euro hits a 5-year low. Banks, and more banks. Deutsche Bank and Commerzbank beat. Credit Suisse posts a bigger loss than forecast. Plus, big tech, big divergence. Alphabet tumbles on disappointing ad sales as Microsoft jumps on robust cloud demand. Now, first thing is first, so as always, let's check in on the markets because the movement gives us a good indication of where people still see a risk-off mood or whether they're quite buoyant because of some of the corporate news. So first of all, the European stock 600 gaining some 0.1%. It is very clear that we've had a lot of earnings, and it's a bit of a mixed bag when it comes to corporate earnings. Some of them better than expected, others worse than expected, and some of the better than expected see their share prices falling because they disappointed investors on higher valuations. The Credit Suisse also shedding more executives, and that's having an implication for a lot of the banks. Technology stocks, now they got a beating yesterday, certainly in the U.S., now pretty much unchanged. Dollar, always a good idea to look at dollar, 1,238, so we're choosing the U.S. dollar index, not the pair, and then we're looking at Bitcoin just under 40,000. The other currency that we really need to look out for is, of course, yuan and some of the pressures there. Now, if you look at the individual map or the individual countries of the European map, I find this maybe, without a doubt, the story of the day because we see Russia and Gazprom today saying that we'll cut off gas supply to Poland and Bulgaria. What does it mean for this country, extremely reliant on Russian gas? What does it mean for Italy? What does it mean for Germany? You can see this stock, the index, actually FTSE MIB down to 0.3%, the DAX pretty much flat. So Moscow has, as we're saying, cut off the gas supply to Poland and Bulgaria, escalating Russia's energy standoff with Europe. European leaders face a choice now of either accepting Putin's demand to pay in rubles or actually face a prospect of energy rationing. Well, the euro is sinking to a 5-year low on the news. Joining us now is our Western Europe managing editor, Chad Thomas. He's in Berlin, and our energy reporter, Rachel Morrison. So thank you both for joining us. First of all, Rachel, how much pressure could this put on European energy markets?
Yes, as you say, gas prices have risen quite sharply this morning on the news. And really what that's coming from is the wider impact, what this could mean for other countries. So these are the first two countries which have had payment deadlines on contracts since Putin's demand for ruble payments. And over the next month, we're going to see those deadlines for payments arrive for other countries, for the bigger importers like Germany, Italy, the Netherlands. And so really that's what the market is looking at, the risk of further supply cuts to other countries. And Germany, we're hearing that that would be a lot more significant for overall gas supply for the country, but also for Europe. And this is all coming at the same time as Europe is trying to refill gas storage ahead of next winter. So even though the weather is milder and it's not winter, this is still going to have an impact for prices as companies and countries rush to try and fill storage.
So, Chad, talk to me a little bit. I mean, if you're Germany today, if you're Italy today, you have to decide on whether you pay in rubles or face energy rationing. What kind of decision, what kind of thinking are they putting in place? And, you know, what conclusion do you think they'll actually end up with?
Well, Francine, we haven't heard very much from Germany, from Italy, from the EU at this point. Certainly, they are behind closed doors assessing the situation at this moment. All eyes certainly on Germany. They are the biggest gas importer in the region from Russia. And we will be hearing from the German government this afternoon. They have a number of events scheduled where ministers responsible for these topics will be speaking, so they certainly will be asked on it. Germany has said in the past they will not pay in rubles, so it seems hard to believe that they're going to change their mind on this. As Rachel was saying, the next payments in Germany are coming due in May. And so it really is a question then at this point whether Germany takes some action here or they wait to see what Russia does. But it seems unlikely that Germany would change its stance at this point, and they maybe will take matters into their own hands given what we've seen transpire overnight.
Yeah, we're also getting some breaking news. Chad, BASF to wind down most remaining activities in Russia and Belarus. Chad, what can you tell us about the comments from the Commission President Ursula von der Leyen? She was saying that first they find this outrageous, the fact that they cut the supplies, but they also have contingency plans, and now they're looking at, I guess, alternative sources of energy. What is she talking about? Could it be a stockpile release, or is it actually trying to get, some of the fuel from other parts of the world?
It's potentially a little bit of both, Francine. They obviously have been preparing across the European Union for this to potentially happen. And so we know, for example, here in Germany that they have been stockpiling their reserves. They have been speaking to other potential partners where they can get both gas and oil. There is an EU meeting happening today where they're talking about the next round of sanctions actually on Russia. Let's see what impetus the news from overnight gives to those discussions. But certainly they have been preparing for something like this to transpire. And now that it is happening, we'll have to wait and see what exactly the actions are that they decide to take.
Great. Thank you so much for joining us. Our Western Europe managing editor, Chad Thomas, and our energy reporter, Rachel Morrison. Now joining us to talk about the markets, gas supplies, and cutting them off is Fiona Frick, Unigestion Chief Executive. Fiona, thank you for joining us. And in the studio, what a treat. There's so much going on. As soon as you wake up and you see Russia blocking gas to Poland and Bulgaria, does it mean that this is a new normal, that we'll have to find alternative sources? And will it really hurt a lot of the companies in the next earnings season?
I think it's a new normal that will continue. Obviously, transition to other sources of energy than gas coming from Russia or oil coming from Russia is something which is already planned. And if you look at Paris COP alignment 2050, so I think this will accelerate on the medium term. It creates, however, volatility on the short term for countries which are very dependent on these countries, for gas, for Russia, obviously, as you said, for Germany and Italy. And the question there, you see that there is a revival of some coal energy, which are more brown energy, in the meantime, to cope with that stress.
So what does it mean actually for your investments? You have portfolios. Do you get out of, if we're looking at rationing energy, and I know we talk about it as if, we're going to the park and pick up tulips, but this is a huge deal. It means that, parts of the economy could be left without energy.
Yeah. So what it means, obviously, is that inflation is back, obviously, not only because of energy, but also because of food. And therefore, we have to adapt our portfolio to an inflation environment. It means that we believe still in equities, but more in defensive equity, quality equities, perhaps less growth, tech-oriented equity, which is a bit of a reversal versus last year. So because we have to take into account that we are in a world where obviously energy prices are going to stay high for quite a while. There are other commodities which are quite high, inflation which are numbers which we have never seen, central policy that are becoming that will become more restrictive in monetary policy, less fiscal policy. So a portfolio which is more defensive than I would say that last year.
Okay. Is there anything that you find particularly attractive right now that other parts of the markets have not looked at? I don't know whether there's an asset class or actually just going to bonds because of this inflationary pressure on yields across the curve.
So obviously we won't go to bonds because with an inflation at 7 and bond yield at around 3 for the 10 years.
But they're going up. Slowly, but they're going up.
So we still prefer inflation asset classes like equity. But equity, we have to be quite specific to take exposure in companies that will be able to price in this inflation on the consumer, because if not, the margin will get squeezed.
Which is not toothpaste. It's probably luxury.
It can be pharmaceutical, it can be some stable sectors where whatever happens, you need to buy them.
And of course, you can't have that, too much exposure to China, given we think that they will continue with this COVID-0 policy. So does that really restrict the number of companies that you have at your disposal?
I think, yeah, it restricts the company you have at your disposal. I think the problem with China COVID is not only the problem for China, it's a problem for all the economy, because obviously it puts some disruption in the production chain for a lot of companies. So we have to be careful for that also. And some of the earnings that went out yesterday highlighted that, the impact of the COVID in China.
Fiona, thank you so much. Fiona Frick from Unigestion stays with us. We have plenty more questions to ask, including maybe crypto or not, whether that's a hedge against inflation. Coming up, we hear from Credit Suisse chief executive after another quarterly loss for the bank. That's coming up next, and this is Bloomberg.
It's good to see positive net new assets, but it's not something I'm jumping about because they are still, I would say, at the low level. It's not near our target.
You're not cheering?
I'm not cheering, no, but they're solid, and it's a good reflection that we have strong client franchises across the board in all regions. Actually, Switzerland was very good. Especially our premium clients business, ultra high net worth business was very good, but we also had some solid net new assets in Middle East. So I would say it's a step in the right direction, but quarterly net new assets is not something I'm too focused on anyway. It's more like a mid to long-term metric.
A number of people have said to me that this bank is now very squarely a takeover target. How vulnerable is it, and will you fight to the death to keep that brand independent?
Look, we are very much focused on our strategy, implementing our strategy. This is how we'll create value for our shareholders. If we get back to the 10% ROTE by 2024, which is our target, the share price and the valuation of this bank will go back where it belongs to, and so will this brand.
How do you get back to that return on equity? What is
by
going to be the
implementing our strategy?
One final question in terms of the biggest risk. We see escalation, Russia cutting off gas to parts of Europe in the past 24 hours. Thomas, how do you see the risk from the war in Russia-Ukraine? What is the biggest unintended consequence, the biggest risk for you in markets, in your business?
Well, we see it really in all the businesses, whether it's on the investment banking side, where you have much lower capital markets activity, whether it's in wealth management or asset management, where clearly the market downturn resulted in lower assets under management. Mm-hmm. And so there are primary and secondary effects.
Is that your biggest headwind for this year?
It is a headwind for all of us. I mean, it's not only a Credit Suisse headwind, it's for all of us. But, you know, markets will recover. And so we obviously, firstly, are worried about the people in the Ukraine. And that's what we really care about, and hope that things will stabilize there soon. And then the markets will follow.
The Credit Suisse chief executive there, Thomas Gottstein, speaking to our very own Manus Krani in Zurich. Manus joins us now. I guess, Manus, the concern is that he keeps on going back to the strategy, and the strategy could be good, but people are really focusing on these legal costs, and they just keep on rising with no real end in sight.
And there is no real end in sight, and I challenged him on that. The second loss in a row. You promised us a year ago a clean set of numbers in 2021, and yet there is more revisitation of these provisions. He used the word transition. People are tiring of the word transition in the inflation narrative and indeed in the Credit Suisse environment. If you look at the gutting of the top level again, the CFO out. He is gone after 10 years. The CEO of APAC is moving aside, and we have new Edwin Lowe stepping in. The chief legal counsel goes after 10 years, Romeo Cerruti. He has gutted this bank, some would say, of the risk takers and of the historical people in the business. He is still there. He was around during Greensill. He was there during Archegos. There's no doubt about it. This is still a bank in transition. No sign of any capital return. And Francine, when it comes to downscaling, UBS did well in the investment bank yesterday. It bolstered them. Rates did well to bolster UBS. Neither of those things come to pass at Credit Suisse. You're looking at fixed income down 50%, equity sales down 50%. This certainly is a bank that is in a tough transitory environment. Francine.
Manus, thank you so much. A really fantastic interview with our Manus Cranny and Thomas Gottstein. I enjoyed immensely listening to it. Now let's get back to Fiona Frick from Unigestion. Fiona, we made a nice chart for you. It's a Frick kind of chart, and it's looking at euro and the fact that euro could be looking at parity on this gas flow escalation. Again, does this change kind of everything? We do have the chart. We will bring it up. There it is. But as if by magic. I mean, what does it mean if we do touch parity?
That means that the market is seeing that euro is not in a very good position because obviously it has inflation, and the central bank policy has less leeway than in the US, for example, because the growth is not as strong as in the US and the unemployment rate is not as strong as in the US. So obviously when you look at the European situation and the US situation, which both have to struggle with growth coming down and inflation coming up, US is much more better positioned than Europe.
So why hold any European stocks at all?
Obviously, the thing is, when you hold the stocks, it can be denominated in Europe or it can be denominated in dollar. In fact, what you have to see is where is the production done and when is the consumer done. So you can have a Roche company or a Nestlé company, although they are based in Switzerland, they are not neither Swiss, neither European, they are global companies.
Is there, how do you position for a policy mistake? And I know it's extremely difficult, but if you believe that actually central banks and the Fed are really behind the curve, again, what does it mean for how you want to protect yourself?
So obviously we think that policy mistake is the biggest risk because central banks are quite behind the curve. Last year they were speaking about transitory inflation, and now they are recognizing that the structural and the pace of going up in terms of rate has accelerated quite dramatically. So obviously the accident from central bank is a risk which is quite important. Obviously, we don't go in bond market. We stay allocated to equity, and we try to be in sectors which are not too sensitive to duration.
Such as, I mean, again, it's healthcare. It's some, I guess, the ones that have pricing power.
Defensive stocks, less technology stocks, not highly.
Crypto? Is there anything that you do with crypto right now?
I think crypto, it's interesting because for some of our clients, which are typically family offices and high wealth individual, it's starting to be a diversification assets. The idea being that the long-term bond market has been quite manipulated by all the buyouts that has been done by the Fed and the other central banks. So the idea that crypto are not correlated to bonds and that can be a sort of digital gold. So it is starting to get a place in portfolio in an asset allocation as a diversification assets.
Fiona, talk to me a little bit about what's priced in, you think, in terms of a possible oil embargo or a gas embargo right now between Europe and Russia. If you know, we could be in a week looking at all supplies being cut off between the two countries, or I'm thinking of, you know, Germany and Russia or Italy and Russia. Will the market really reprice because of that, or are they already, you know, starting to look at that possibility?
I would say that the market hasn't totally repriced. I think the market has priced inflation, and when you look at break-evens and things like that, the market has not really priced a recession yet. And the problem with yield coming up and growth coming down, obviously equity can be at other level of valuation that they are today. And if there is this crisis of energy that continues to accelerate, and then Germany has been quite clear what it would cost to cut gas to Germany, it will have an impact on growth, and therefore it will have an impact on equity.
Thank you so much, Fiona Frick there, Unigestion Chief Executive Officer, with some of the insights on what she wants to do with her portfolios. Now, coming up, we'll take a closer look at the implications of Russia's move to cut off gas supplies to Poland and Bulgaria. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Russia's Gazprom says it has cut off gas to Poland and Bulgaria in a major escalation in the energy standoff with Europe. Moscow is making good on a threat to halt natural gas flows to countries that refuse to pay in rubles, which the European Union has refused to do. Now, China is set to step up infrastructure investment following following a meeting chaired by President Xi Jinping. Meanwhile, satellite images show China's lockdowns have crippled construction and port activity to levels below the first COVID outbreak in 2020. And the World Bank is extending $600 million to Sri Lanka in financial assistance to help address the economic crisis. The country's presidential office says the aid will be delivered in 2 phases. It will help the country meet health, agricultural, food, security and gas needs. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Big piece of news because there was so much concern out there, or so much anger, I would say, amongst traders about the LME and how they handled the nickel situation. The LME Chief Executive Matthew Chamberlain will remain in his permanent role. I don't know whether we'll see possible litigation from some of the companies and some of the trading houses that got their, of course, trades annulled because of what happened with nickel. But certainly it's not means that the problems go away. Coming up, soaring energy inflation and now imported food prices. We discuss that next. This is Bloomberg. Weaponizing energy, Russia cuts gas supplies to Poland and Bulgaria. While gas prices soar, the euro hits a 5-year low. Banks, and more banks, Deutsche Bank and Commerzbank beat. Credit Suisse posts a bigger loss than forecast. Plus, big tech, big divergence. Alphabet tumbles on disappointing ad sales as Microsoft jumps on robust cloud demand. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, let's check on the markets because it does give us a good idea and a good implication of what risk we're seeing out there, what traders are worried about. And, of course, they have to grapple with a million things. First of all, it's all about monetary policy being normalized. It's this gas flows being cut. What does that mean for countries such as Germany and Italy? A euro falling to a 5-year low as Russia's upping up the ante on these gas supplies. And then, of course, there's China and the COVID zero policy and what that means across the board. Now you can see natural gas is gaining some 6.6%. The China 10-year yield, it's 1.6 basis points higher. And then in general, it's really a question of what happens to euro, whether we're going to see parity, currently at 106.13. Now, a recent study by the London School of Economics suggests that Brexit-related trade barriers have driven a 6% increase in UK food prices. This comes as consumer prices rose 7% in the year of March, and soaring energy costs, of course, are the biggest contributor. Well, joining us now is Zoisa North-Bond, Chief Executive Officer of Octopus Energy Generation, which is the renewables generation arm of Octopus Energy. Zoisa also heads up the company's business retail unit. Great to have you in the program. Thank you so much for joining us. There's so much going on, and actually, if you're already struggling to make ends meet, I mean, some of this inflation pressure and energy prices are so hard. Do you have any visibility on what renewables mean for these prices to go down?
Yes, I think what we are really seeing is that to build our way out of this crisis, we do need more renewables here in the UK. And we need to be prioritising the projects that we can build most quickly and at the cheapest costs. Which are, because there's concern, I mean, even last year there were, we have wind farms, but then if you don't have enough wind, then those get halted and we have to go back to coal. Yeah, no, sure. I think what we need to essentially do is make sure that we focus on developing more renewables, but then also looking at electrifying things as much as we possibly can in homes into the future. So looking at things, for instance, for consumers like fitting heat pumps versus gas boilers. They're a massive contributor to not only global emissions, but we're also hugely dependent on using gas for those. So things like heat pumps, which can use renewable clean generation, I think could be really important for the UK into the future. Is there a piece of technology that would really help renewables get off their feet? And again, I see it as a problem of timeline, is that I don't know how long you need. Even the fastest piece of technology or the fastest renewable takes, what, 2, 3, 4 years, I imagine? And we're talking about Russia cutting off gas supplies today. No, sure. And actually what we're finding, we actually have an onshore wind model called the Fan Club, which is basically wind turbines located close to consumers. And as the wind blows, it means that they can get almost as much as 50% off their electricity. Now, we see that combining community support, relaxing some of the red tape that we have here in the UK, we could actually be building these turbines in under a year.
And then they would be fully operational, like
they would
shortly
be fully
afterwards?
operational. They're single turbines, close to consumption. They could be built very, very quickly, and also reducing consumers' energy bills as a result.
And there's enough wind. I mean, I know this. I mean, this is like a flippant comment, but actually, I was shocked. You know, I've lived in the UK almost all of my life. We're used to the wind, so it's unclear why we had a problem in 2020.
Yeah, look, I mean, renewables are intermittent. The sun doesn't always shine and the wind doesn't always blow. But what we really should be doing is focusing on building as much clean electrons as we possibly can for the UK population, and then using gas or perhaps other sources like nuclear very much as fillers, or when those times happen. And then actually long term look at electrifying, and we look at things like electric vehicles and the ability that they will have to store electricity, for instance, into the future. I think by 2030 we're predicting there will be 11 million on the road, and actually we only need 10 million to make sure that we balance ourselves on a kind of peak day in using electricity here in the UK.
What about water? I mean, being an island, how much of a contribution can the water, hydrogen, and things like that do to the renewable space?
Yeah, I think hugely. The offshore wind program here has been something over the last decade, which has been nothing short of incredible. We're now a world leader in UK wind power, and that's because there was really clear direction from government, which brought the investment in, and also has driven the innovation for us to be able to build that. So we need to now do the same for things like floating offshore, and then of course green hydrogen as well. Green hydrogen for heavy industry could be something that's really important.
Is there enough commitment for from the government to get this done, or is there a setback because there's I guess not distractions, but they're worried about foreign policy and things like that, and so maybe it's not getting the support it should?
Yeah, I think really yes. I think the energy security strategy that we saw published 2 weeks ago, it outlined a really great green net zero future for the UK. I think probably what it maybe could have more of is prioritisation, so things that really are going to impact customers quickly. So we should be prioritising the things that we can build the quickest and in the cleanest ways.
Do you worry about a shortage of any kind? So, a lot of these renewables will need lithium, it'll be a nickel. If there's a global race to be much more renewable and cut off that dependency from Russia, who has priority?
Yeah, and I think, I'm not really an expert in the supply chain, but I think what we see is that, again, if we start to prioritise the things that are really important, because I think at the moment, perhaps our strategy is very wide, and it really doesn't give indicators over what should come first. And it's about actually focusing in on those things and being able to deliver the things quickly that we can do.
Great. Thank you so much for all of the update. Zoisa North-Bond there, the Chief Executive Officer of Octopus Energy Generation. Now, coming up, Google's parent company Alphabet reports first quarter sales falling just short of estimates. We break down the numbers next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get back to earnings news. Deutsche Bank has posted a better than expected first quarter profit as investment banking revenues rose, but it warned that Russia's invasion of Ukraine could also hurt full year results. Well, the Chief Financial Officer, James von Moltke, spoke to our Danny Berger about the economic outlook.
For the economy, there are other effects out there. Of course, the supply chain disruptions, the lingering effects of COVID, including lockdowns in China, and naturally high energy prices that actually existed prior to the war effects. All of those, I think, are having an impact on the economy and business confidence. And we also stand in front of what will be a relatively historic rate rise cycle that's beginning in the United States.
Well, that was the Deutsche Bank Chief Financial Officer, James von Moltke. Now, let's also return to tech earnings. Google's parent company, Alphabet, reported first quarter sales that just fell short of estimates. Meanwhile, Microsoft's cloud growth propelled quarterly sales ahead of the street's forecast. So joining us now is Laura Wright with all of the latest. So, Laura, if you did good, you did really good. If you did badly, you're getting slammed today.
That's right, and we're seeing diverging fortunes in pre-market trading. Microsoft in the green based on that revenue beat, and Alphabet selling off. Well, if we start with what happened in Alphabet, YouTube, the dream that YouTube is a real driver, an engine of growth going forward, that was shattered. A miss of $500 million on revenue for this quarter, landing below $7 billion. The reasons for this, a couple really. That QuickTake is what the platform that Gen Z are using right now. YouTube failing to catch up in spite of launching and seeing growth in their Shorts platform. Now, another competitor for YouTube also is, back to you, Francine.
All right, I think Laura's just having a little bit of issues, and then we'll get back to Laura for a full analysis of tech. Now, let's broaden out the reach. We're bringing in Bloomberg QuickTake's Alex Webb with all of the latest on Google, Microsoft. We're going to talk balance sheets. It's going to be so much fun. We're going to have TikTok. All right, so if you're doing well, it's great, but actually there's a huge divergence between the winners and the losers.
Absolutely, and it really shows actually the distinction between Google's business and Microsoft, that Google is still fundamentally an ad tech company. It derives most of its revenue and then by inference most of its profit from advertising. So if there's even the slightest wrinkle, given the levels at which it's trading, then it starts to get punished by investors. It has been trying to get into the cloud business. It is the third biggest cloud provider in the world, behind Microsoft and Amazon. But it is a big gap between the second and third place, and it's been suffering from failing to get into that as quickly as it could. Right,
so who's the biggest winner? If you look at some of the things, I mean, are we just all going after content on TikTok, and it means that, you know, a company like Meta will just have to spend so many dollars in there?
There are a couple of different moving parts here with advertising. I know you had Mark Reed on earlier. He was saying that, look, they are still growing apace. It's just that they are feeling more... it's not quite as untrammeled as it used to be. That as economies start to tighten, the first things that companies who need to keep a close eye on their budgets, the first thing they cut is usually their marketing spend. You tie that with the difficulty that Google and Facebook are increasingly having to be able to target their ads, and that is because of Apple. What Apple has done is really crack down on data sharing between apps. It used to be the case that you could easily track people, see what they were doing, what was driving spending. It's getting harder. That makes it harder for Google and Facebook to demonstrate their value.
But Alex, so do a lot of the companies, because of COVID and lockdown, do they hang on to that spending that they would have done in advertising? So even if we see a downturn, even if we see a recession, they still have that cash to spend that they don't want to deploy anywhere else.
So they are cash-rich companies. What we're seeing with Facebook in particular, it's spending a lot of money, of course, to get into the metaverse, but it's also spending on its core products, on Instagram and on the Blue app, Facebook itself, in order to try and offset the competition from TikTok. It's trying to innovate in those core spaces. Google is doing the same. They talked about it yesterday. YouTube has its Shorts business, which is almost a direct copy of what TikTok does. So it is trying to innovate as well. It has so much money, it's hard to know if it's spending it correctly and if it's making the massive bets, for example, that Microsoft is doing by buying Activision.
Okay, I need to ask about Twitter because A, it's a great story, 2, it involves Elon Musk. I mean, is he really going to spend $44 billion and then not have advertisers? This was a point that Mark Reed of WPP was saying.
It seems highly unlikely. One thing that has been posited is almost doing the inverse of what Netflix does, right? So Netflix was a paid tier. It is going to extend into advertising. Well, Twitter is an advertising-based business. Maybe it extends into a paid tier, and if you pay for that tier, you don't get ads. There's a benefit to that. You can get more predictable cash flows, but your upside is limited. That Facebook makes something like $250 a year per user in the US from selling ads. There's no, the sky's the limit, in theory. If you're only charging $5, $10 a month, the likelihood of being able to charge $20 a month to use Twitter is pretty unlikely.
Do you see the ads? I mean, I know I have the ads, but I don't even see them anymore. I have, like, no idea what's scrolling.
Which is part of their problem. That, like,
I'm the problem, yes.
A lot of the sophisticating advertising on Twitter is they place videos in your feed, which are from third parties. They might be from news organizations, and they sponsor those videos. That's some of the more sophisticated advertising that's happening there.
Yeah, the problem is that you don't see it. Maybe it's subliminal. You see it without realizing.
Well, Facebook would often make the case that actually TV advertising was ineffective because during the ad breaks, people are looking at their phones and looking at Facebook. You can still hear an ad, though, on TV.
Yeah, so it's always coming in. Alex, thank you so much. Alex Weather with a little bit of advertising psyche as well. From Bloomberg Quick Take, now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Credit Suisse has reported a bigger than expected loss and parted ways with 3 senior executives. This as the Zurich-based bank warns that the full damage from one of the most turbulent periods in its history is still to be accounted for. The lender's quarterly net loss was driven by legal expenses as well as a charge related to Russian exposure. Now, Bloomberg has learned that Mattel has held talks with at least 2 private equity firms about a possible buyout. That would give the maker of Barbie and Hot Wheels a chance to grow in private hands. The talks with Apollo Global Management and Alcatratron are said to be in the early stages. Lail Brainerd has been confirmed as Federal Reserve Vice Chair in a 52-43 Senate vote. She is the first of the 4 central bank nominees, including Chair Jerome Powell, set for consideration by the chamber. She won over Republicans on the Banking Committee after her confirmation hearing, though most GOP senators still oppose her because of her views on regulation. And a study suggests Brexit-related trade barriers have driven a 6% increase in UK food prices. Researchers at the LSE's Centre for Economic Performance says inflation for food products Britain tends to import from the EU, like fresh pork, tomatoes and jam, was more pronounced than things like tuna and exotic fruits that come from other nations. The study covered 2 years to the end of 2021 and attempted to strip out the effect of the pandemic. The world's richest person can't afford too many days like yesterday. Elon Musk's stake in Tesla plunged by more than $32 billion. Investors assessed his deal to buy Twitter and gave their verdict by sending shares of Tesla down 12%. Musk has pledged some of his Tesla stake to secure that Twitter deal. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Coming up, we get back to the markets as the euro falls for a 5-year low amid threats to energy supplies from Russia. If we look at parity, what does that mean for a lot of the earnings results? We'll dig deeper with our markets editor. This is Bloomberg.
We see it really in all the businesses, whether it's on the investment banking side, where you have much lower capital markets activity, whether it's in wealth management or asset management, where clearly the market downturn resulted in lower assets under management, and so there are primary and secondary effects. See positive net new assets, but it's not something I'm jumping about because they are still, I would say, at the low level. It's not near our target.
You're not cheering?
I'm not cheering, no, but they're solid, and it's a good reflection that we have strong client franchises across the board in all regions.
Well, that was the Credit Suisse Chief Executive Thomas Gottstein talking about the risks of the war in Ukraine and the outlook for the bank. Shares trading lower today. Now, in the last couple of minutes, we also have, of course, our biggest news, if I'm frank, is the fact that Gazprom, belonging to Russia, said it would halt gas flows to Poland and Bulgaria, and that they will keep the supplies actually switched off for the 2 countries until they agree to wield into Moscow's demands to pay for the fuel in rubles. And just minutes ago, it's the Austrian Chancellor, Mr. Karl Nehammer, commenting on these gas payments on Twitter, saying that Austria will continue to pay for Russian gas in euros. Of course, the other main questions, will France do the same? Will Italy and Germany do the same? And if they don't, and if we see those supplies cut, what does it mean for a rationing of energy? What sectors do they close down? And overall, what does it mean for security of supplies going forward? So let's get into these key market drivers with our market editor, Christine Aquino. Christine, good morning. First of all, to you. I mean, I'm a little bit surprised that we're talking about a possible oil embargo, certainly a gas embargo, because this is escalating. It was a pretty brutal escalation, and I just don't see, I could be wrong, but I just don't see now Italy and Germany turning around and saying, hey guys, we're just kidding, I'm going to pay in euros. So if we're looking at a gas embargo, what does it mean for the markets?
Well, Francine, very bad things probably, and I think that is what investors are trying to wrap their heads around at the moment, just the sheer impact of this, because this is not only something that will impact, of course, commodity markets, which will be the very obvious and the very imminent sort of impact, but really across markets as well. I mean, it will be quite a hit to sentiment in terms of just investors, you know, having to suddenly think about what would rationing mean for certain sectors of the economy. Will they have to, as you say, shut down certain sectors and prioritize which ones are the most important? So that could have very big implications for certain industries.
But they're not priced in. It's not priced in, which is why I don't really understand. I know we'll look at euro parity in a second, but why are the markets not sitting up and taking notice of this today? Why are they waiting for, you know, tomorrow, the day after?
Well, Francine, this is classic markets just really being bad at pricing geopolitical risk. You know, I think, you know, it's probably investor psyche that once we saw this escalation from Russia, the response from the rest of the European countries would be one that would be guided by rational thought, you know, and I think that is the I guess the optimism eternally built into markets, and investors assuming that things will get resolved eventually.
Yeah, I mean, I guess the worry, I mean, or maybe there's hope that there's some kind of stockpile release that, you know, in the short term will benefit us. Okay, we had a lot of earnings. I mean, I can't remember, like 300 companies reported earnings, and it's a little bit of a mixed bag.
Absolutely, Francine. And of course, the ones garnering the most attention, of course, are the biggest ones, all the FANG sector companies that have reported. And I think this really just kind of brings us again to that discussion of, is tech still too expensive at this point, right? We've seen very...
Well, it's expensive for sure.
Exactly, yes. But how much more is it going to come down and cheapen up before it's actually a worthy buy? This is, I think, the question that a lot of investors are asking right now. And, you know, various measures we've seen really come down, right? The PE ratio in the FANG stock specifically, that has really closed its gap with the broader S&P to the least in years, I think, since FANGs have existed in their current form. But there are still other expectations that are still too lofty probably and have room to come down.
And then the banks. So I feel like they've swapped roles. So there's Deutsche Bank actually beating estimates, and Credit Suisse, they just cannot get away from these legal costs, and there's no real end in sight.
Absolutely. And you know, there are really a lot of kind of idiosyncratic stories for certain banks, like Credit Suisse you mentioned, that are facing these costs. But it seems like largely the picture is one of cautious optimism, shall we say, because, you know, let's face it, the trading turmoil of 1Q has been quite a boon for a lot of these banks. You know, trading revenues you could really see reflecting just how much money has changed hands and how much the banks have benefited from that. But then on the other hand, there is a good bit of caution built into their future outlooks beyond 1Q, talking everything from China-related risks, and we heard again from the Credit Suisse CEO talking about Russia-related risks. And so they are still very much looking at this geopolitical risk, what that means for business moving forward.
But you could see a situation where actually, so we have a gas embargo, we have inflation expectations, you know, going higher, really quite out of control, then monetary policy having to follow, and so yields kind of going crazy.
Absolutely. And we are seeing that now in the bond market. I mean, we saw 3 sessions of really big bond gains. And we were thinking, you know, oh, this might have been, we've seen the peak of yields finally past us, investors piling back into bonds. But today, the story is very, very different. Focus is back on inflation, and bond yields are reflecting that.
Yeah, and euro parity? What? Let's all go shopping elsewhere in the States. Christina Aquino, there are markets editor. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kailey Leinz are in New York. Anna Edwards here in London. They'll talk about, of course, these gas flows. They'll talk about bond yields, COVID in China, and monetary policy. This is Bloomberg.
What's happening now is such a supply chain shock that you're having this inflation come through.
There's still quite a bit of momentum in the U.S. economy. So when I think we discuss this growth scare, it's really more a story for 2023.
I think the playing field is much more level now, active relative to passive.
But more importantly right now is the corporate earnings. And corporate earnings so far have been very reliable, very strong.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Wednesday, April 27th. Our top stories today. Google parent Alphabet comes up short in its first quarter revenue, while Microsoft does better than expected thanks to the cloud. We'll hear from Facebook parent Meta after the bell. A bigger loss than expected for Credit Suisse. Deutsche Bank raises the outlook for its investment bank, but costs weigh on the stock. And Moscow makes good on its threat. Russia cuts off natural gas to Poland and Bulgaria. European gas prices surge more than 20% as governments on the continent wonder who is next. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards, live in London with Kriti Gupta and Kailey Leinz in New York. Matt Miller is off today. And Kailey, it really is the gas story that is dominating a lot of the conversation amidst the earnings here in Europe. But I know tech earnings front and center over in the United States.
Yeah, it's tech in the U.S., energy in Europe, and in Asia, still all about China and the growth outlook there given the COVID zero policy. What was interesting is you actually saw most Asian stocks lower on the day. The MSCI Asia Pacific Index actually falling to its lowest level since mid-2020, down about 1%. But the bucker of that trend was actually Chinese equities. The CSI 300 rising almost 3%. That is after Xi Jinping came out, talked about more infrastructure spending to shore up the economy. So that actually led to a really big move in industrial stocks in China in particular. They were up about 6%. What's interesting, though, is while you see some positive sentiment finally coming back into Chinese equities, it is not translating into the South Korean won. Actually, the weakest Asian currency against the dollar today, weaker by more than 1% at its lowest level since 2020, around 1265 or so. The concern there being slower growth in China means slower exports from South Korea, and that could weigh on growth. Finally, elsewhere in FX, your big outperformer on the day is the Aussie dollar. It is stronger by about 0.5% or so at around 71 cents to the US dollar. Kriti, that is after higher than expected inflation. Traders are betting on an RBA hike next week.
Yeah, well, Kailey, what's really kind of interesting to me here is what we're seeing in futures, because I think the assumption coming into at least the pre-market session, at least here in the States, was it would be a risk-off day driven by those less than great tech earnings that we saw after the bell yesterday. But take a look at this. Futures actually up 0.9%, and you're actually seeing this kind of risk-on mood across the asset classes. 10-year yield up at 276, up 4 basis points. A similar story even in crude, up only 0.7%. Not a huge move for oil markets, but still in the green. Even Bitcoin up 2.3%. And this really tells you here the story of simply this risk-on move. And I wonder how much of this is simply a bounce back from the almost 3% losses that we saw yesterday, of course, driven by tech. Is this something that's priced in? We're going to hit it throughout the rest of the hour. Anna.
Yeah, absolutely. That is the context of what we're seeing here today. The big losses we saw on Wall Street yesterday. Europe actually did represent a lot of what you were suspecting there, Kriti, that real risk-off tone at the start of trade. The first half hour of our trading day here in Europe was dominated by moves lower for European equities on concerns about what this Russian gas move, cutting off supplies to Poland and to Bulgaria, what that would mean for other European countries. Would there be others that would be next? And on that note, we just saw a statement from Russia coming through that says 4 European gas buyers have actually set up accounts to pay in rubles, or to enable them to pay in rubles should they wish to. So we'll monitor that story with interest. This is what happened to natural gas prices at the start of the European trading day, or at least jumping 20% at the start, pairing those gains, but still elevated, still up by 3.7%. The euro also being caught up in this. We do still have a 105 handle. We've been volatile on the euro dollar through the morning session here. So 105.96 is where we trade on the euro. Weight being applied to the euro as a result of concerns around growth. Germany in particular, questions about what would happen to the German economy if we did see Russia make a similar move there. It's not doing that right now. It would be a concern to companies like Mercedes-Benz Group if it were to see a block on Russian imports of gas. 65.21 is where the Mercedes share price trades. This is what happens when you are positive about your ability to pass on costs to consumers in this earnings season, up by 3.7% as a result of that on the Mercedes share price. The mix. They're trying to move more towards that luxury end as well, and that is benefiting the way that their results have been received. Deutsche Bank, they tried to upgrade guidance, or they have on certain parts of the business, but it is fear around costs, and in particular compensation costs, that is weighing on that stock. Let's have a look at Russian assets. There is a lot to talk about when it comes to Russia today, and of course a big focus is around the ruble. Russia wants to see energy paid for in rubles, certainly gas, and that's why they focused on Poland and Bulgaria, because money had become due. Money is not due from the German buyers of this gas until May, but that's where the focus will switch. We'll continue to focus on this story as we go through the next month or so then, Kailey.
Absolutely, Anna. That's over the next month. But let's talk about what else we're going to get on this Wednesday. No surprise, there is a lot going on. At 10:30 a.m. New York time, we're going to get the weekly EIA oil inventory report. Then from fossil fuels to clean energy, top climate leaders will be convening at the Bloomberg Green Summit to create solutions and drive actions that will shape the future of our planet. At today's summit, we'll be hearing from the White House climate advisor Gina McCarthy, TPG's Jim Coulter, among others. And of course, more earnings on deck, big tech earnings in particular. Facebook's parent Meta will be reporting after the bell, Creedy.
Yeah, Kailey, let's stick with that big tech earnings themes, because after the bell yesterday, we got mixed results from mega caps Microsoft and Alphabet, reporting once again, like I said, post-market yesterday, are muddling the picture for the sector. The NASDAQ 100 index falling to its lowest level in more than a year yesterday. Let's get more on those reports with Bloomberg's Laura Wright. Laura.
Thanks, Critty. Well, diverging fortunes in the pre-market, reflecting what we saw after the bell yesterday for Microsoft and Alphabet. Azure Cloud, bumper growth number for Microsoft, up 46% year over year. That was even higher than what the CFO Amy Hood had forecast. Microsoft Azure is second in terms of market share, behind only Amazon's AWS for the cloud infrastructure business. Now, to the Microsoft 365 on the commercial and consumer side, growth was robust there. Remember that Microsoft acquired LinkedIn back in 2016, and a strong jobs market means that LinkedIn growth was up 34% year over year. Gaming revenue strong also. Xbox hardware up 14% year over year, an improvement in supply chain congestion, and more of us are out there gaming in spite of the fact economies have reopened. Now, YouTube, that was devastating really for Alphabet, a miss of $500 million in advertising revenue for the quarter, landing at just below $7 billion. A number of headwinds were in play here. Competition from TikTok, that's where the Gen Z kids are these days, and those Apple privacy changes that we've discussed. It makes targeted advertising more difficult, and therefore it makes platforms like YouTube less monetizable.
So, Laura, that's the story when it comes to earnings. We are, of course, all watching whether Elon Musk is or is not going to get his hands on Twitter. Of course, they've come to a deal, but whether it happens is another question, and a lot more detail coming out.
Yeah, a lot more detailed factors in play. A $1 billion breakup fee if either party is to walk away from the deal. You could argue that's more of a risk for Elon Musk, because there are still questions around that $21 billion equity commitment. Also, no disparaging tweets about Twitter itself or any employees. Elon Musk is no stranger to saying nasty things about other people on the platform. Only on Sunday, he was trashing Bill Gates. And this risk about Tesla collateral, that Elon's wealth is tied up in. Just yesterday, Tesla closing down 12%. Elon Musk lost $32 billion of wealth because of that. And overall, the electric vehicle maker losing more market cap than BMW and Mercedes-Benz combined. What would Matt Miller say if he were here?
I think we can all gander a guess. Thank you so much to Bloomberg's Laura Wright. Now, let's turn to European earnings. Two of Europe's biggest banks reported earlier on. Traders at Deutsche Bank outperformed their peers on Wall Street, while over at Credit Suisse, it reported another quarterly loss as the lender struggles with a growing burden of legacy litigation costs that continue to batter its reputation. Bloomberg's Manus Cranny spoke to the Credit Suisse CEO, Thomas Gottstein.
It's good to see positive net new assets, but it's not something I'm jumping about because they are still, I would say, at the low level. It's not near our target.
You're not cheering?
I'm not cheering, no, but they're solid, and it's a good reflection that we have strong client franchises across the board in all regions.
Bloomberg's Manus Cranny joins us now from Zurich. So, Manus, this is Credit Suisse's second quarterly loss in a row, a major restructuring in leadership. How significant are those personal changes and also the numbers?
I think the lead here is, there's three things that you can focus on: transition, transition, transition. And again, this time last year, he promised a clean slate. He didn't deliver it, and that's where the doubt creeps in from the market: losses, provisions, and transition. The three major scalps to go. I mean, he's gutted this board. You've got the CFO out. He's been there since 2010. The CEO of APAC, he's moving aside, and Edwin Lowe steps up. And the chief legal counsel, Romeo Cerruti, there for 10 years. Many of these people were there during the green sale, during Archegos, during the other major provision moments. So too was Gottstein, but he's still standing. So these three scalps are gone. This is part of the transition narrative and the de-risking narrative that is at play from Gottstein. In terms of the actual businesses, again, deleveraging in Asia. Credit Suisse is supposed to be a full-scale investment bank. The investment bank, trading down, fixed income down 50%, equity sales down 50%. Rates, interest rates in your world, in the dollar world, they're only going to add $150 million. Nowhere near the $1 billion that UBS were able to tell me about yesterday. This was a CEO who is standing firm. He's got rid of everybody now. The question for me is, will the institutions and the major shareholders back Gottstein to revive the fortunes of Credit Suisse?
Manus, thank you very much. Bloomberg's Manus Cranny live for us in Zurich, bringing us that interview. Let's pivot to one of our other big themes. Moscow has cut off the gas supply to Poland and Bulgaria, escalating Russia's energy standoff with Europe. European leaders face the choice of accepting Putin's demand to pay in rubles or the prospect of energy rationing. Let's get more with Stephen Stapczynski, who is a Bloomberg energy reporter in Singapore. And this, of course, raises questions about the rest of Europe, doesn't it? Stephen, I'm seeing now a red headline across the Bloomberg says Germany is meeting now with EU partners on gas supplies. A lot of people focus now on Germany, and what if they're next?
Absolutely. So we saw prices rise for European gas as much as 24% earlier today because of the risk. Russia crossed that line where they cut off gas supplies to Poland and Bulgaria. While they are small buyers, they did cross a line, and people thought, okay, well, this could potentially expand to Germany. But so far, we haven't seen whether Germany will be paying the way that Russia wants them to. We saw signals last week that there might be a way to do it. But right now, gas is still flowing, and prices paired those gains, and they're back down from the earlier highs. But the big focus now will be, okay, how will Germany pay? How will Austria pay? And how will the other big buyers figure out a way to procure that gas? And if the gas keeps flowing, then the gains that we saw in recent days might start to fall a bit, and the worries in Europe might recede. The big thing is, if Russian gas does get cut off to Germany, that will have a huge impact on their economy, and they might have to even ration gas, and they could fall into a recession. That's what's in stake, and that's why everyone is watching very closely what Germany says in the next day.
Bloomberg's Stephen Stapczynski, thank you so much for joining us. We appreciate it. Let's move over to what's going on in D.C. The Senate has voted to confirm Lail Brainerd as vice chair of the Federal Reserve. Meanwhile, a combination of COVID-related absences and a political spat threatens to delay 3 other Fed nominees. Anne-Marie Hordern, our Bloomberg Washington correspondent, joins us now in D.C. Anne-Marie, give us the latest.
Well, we have Lail Brainerd now governor to now the vice chair at the Fed. And this comes at a time when obviously inflation is a key concern for the White House because it's top of mind of voters ahead of the midterm elections. And when Lail Brainerd was nominated, she had said she was going to put working families first. And that means getting inflation down at a time when people are focused on their jobs and how far their paychecks will go. Leaving her to the side now, there's really a lot of drama about the remaining Fed picks. And it's not drama about whether or not they're going to be confirmed or not. But given the fact that, Critty, as you said, you have 2 senators as well as the vice president having COVID-19, that means the Democrats do not have the votes right now to move forward on Lisa Cook. Then there became a bit of a political spat between Senator Sherrod Brown and Toomey about what to do in terms of Philip Jefferson and Jay Powell. So potentially we might not get the remainder of votes this week. They hang a bit in the balance, but potentially next week. And then, of course, what you really want to also focus on is what's going to be coming up next, which is the hearing for Michael Barr and how he does. Because remember, that is the nomination that the president had to go back and get a second person because his first pick basically had to resign due to that hearing.
All right, Bloomberg's Anne-Marie Hordern in Washington for us. Thank you so much. Now let's get back to the market and take a look at some stocks moving in pre-market trading here in the U.S. A big outperformer is Mattel, the toy maker. There's reports overnight that it is looking at a potential takeover of itself. That's according to the Wall Street Journal, potentially Apollo Global coming in for that one, up 13% before the bell. Another stock moving higher is Visa. This is after it also reported earnings after the bell. A lot of people are out spending with their plastic. It was up about spending volumes up about 17%, that leading the stock higher by about 5% before the bell. One disappointer on the earnings front, though, is Texas Instruments. It had to cut its revenue outlook by around 10%, so below street expectations due to the situation in China. The COVID-0 policy hampering production for this chip maker. That stock down around 3% in early hours, Anna.
Coming up on the program then, Kailey, Freya Beamish joins us, head of macro research at TS Lombard. How does she pull together all the threads we're seeing? Concern around growth in China, the interest rate story out of the US, gas prices and gas supply here in Europe. We'll also talk tech with Kniaz, who joins us, a former Google product manager who's now a partner at Hoxton Ventures. Stay tuned for that conversation around what we have learned this week so far around tech. Plus, be sure to check today's big take story on Elon Musk's $44 billion bet on the future of free speech. Read all about that at NI Big Take on your Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off today. Let's talk about tech because, of course, we got some disappointing earnings after the bell yesterday, something that arguably was coming in, the expectation in the markets priced in perhaps going into those results. This morning, you are seeing futures rebound a little bit for the NASDAQ, but this is really the chart I want to show you. For our radio audience, stick with me. The NASDAQ 100, remember that tech-heavy NASDAQ, year to date dropping a whopping 21% if you round up. That's actually more than what you saw in the depths of the 2020 crash in March of 2020, the onslaught of the pandemic, where we saw a lot of that increased volatility, down 19.8% back then. So this is really important because you're starting to see some of that defensive inflation hedge role that tech was playing kind of dissipate a little bit. A lot of these growth fears actually reflected in tech because at the end of the day, the likes of Apple, Microsoft, even Alphabet, these are all companies that are actually exposed to the economic cycle. Sure, they're a little better positioned to weather the storm, but still extremely exposed to that growth story. So as we look at more of those growth fears, tech is something we're going to come back to. But let's talk about why futures are rebounding today in particular. Noor Al-Ali from the Bloomberg Markets Live team, she joins us now. Noor, let me put that question to you. What do you make of this rebound this morning?
I think that's a very temporary rebound because we are looking at fundamentals that overall don't support growth stocks. We are seeing a bit of a rotation into value. Yes, this morning is definitely a good morning for stocks. It wasn't so earlier in the European session, but what I'm more particularly interested about is basically how the long duration equity play is really playing out in ARK, and that's the innovation ETF for Cathie Wood. And you have seen, in fact, that the net asset value for that ETF is at the lowest since April 2020, and you've basically seen it, pare back all of the pandemic gains that we've seen in the last year, and that just shows you perhaps we are now entering into a new dynamic of thinking. I mean, value stocks have historically underperformed growth in the last 15 years. We're talking about since the financial crisis. Yeah. Now it seems that large fund managers are reallocating those funds, and those moves will tend to perhaps be a lot stickier. So I don't expect that rebound in stocks to last.
Right, yeah, interesting to see the real world fight back against the tech theme, Noor. In geopolitics, that's the thing that dominates here in Europe today, around gas prices and what Russia is doing in the gas market. The euro is weighed down by that, had a 105 handle earlier on this morning. How weak does the euro get on this then, Noor?
Yeah, absolutely. And now it's trading at 106. Look, I mean, that's definitely, I mean, a couple of weeks ago, or, you know, when Russia began its assault or offense on Ukraine, we saw it really play out in gold. You saw gold react to the minutes of what's happening. Now you see that in the euro, and it's quite interesting to see how the euro prices that. You're seeing a lot of risk. I mean, there's definitely some a path to parity is opening up for the euro dollar for sure. And, you know, it's tested the 5-year low. Now we're going at something a lot further, and it's on track to close below its 2-decade-long monthly uptrend. It's a bit of a struggle here for the euro because it hasn't been worth less than $1 since late 2002. And such a move was seen incredibly unlikely before Russia's invasion.
Yeah, I'll be back to thinking about parity. Noor Al-Ali, thank you very much, of our Bloomberg Markets Live team. And for more market analysis, check out the Markets Live blog, MLIV Go. That is the function to use on your terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Google parent Alphabet comes up short in first quarter revenue, while Microsoft does better than expected thanks to the cloud. We'll hear from Facebook parent Meta after the bell. And Twitter has dipped further below Elon Musk's offer price. A bigger loss than expected for Credit Suisse, whose legal bills may keep hurting profits in the coming quarter. The Swiss bank parted ways with 3 more senior executives. Meanwhile, Deutsche Bank raised the outlook for its investment bank after a big quarter for its fixed income traders. The stock, though, very much focused on costs. And it's a major escalation in the standoff between Russia and Europe over energy supplies and the war in Ukraine. Moscow has cut off the flow of natural gas to Poland and to Bulgaria. European gas prices rose as much as 20% in earlier trading. I'm Anna Edwards in London with Kriti Gupta and Kailey Leinz, both with me in New York. Matt Miller is off today. And Kriti, the focus really here in Europe is on the geopolitics. The focus in the US very much on the tech earnings season.
Yeah, and it's this kind of divergence that I think perhaps you're seeing a little bit of insulation in the U.S. market right now. This idea that if you actually look at some of these tech earning makeups and simply the issues that you're going to be seeing where that weakness in those tech earnings are, well, it's not here in the States, it's actually abroad. Google, for example, Alphabet talking about that European ad weakness, that's going to all show up in futures. And that's really where you're seeing 0.9% this rebound, because at the end of the day, if you look at the regional exposure of some of these big tech companies, over half of their revenue still comes from right here in the United States. So I wonder how much of that is feeding into the sentiment. 10-year yield, of course, following the futures lead up to about 4 basis points. Crude, Bitcoin, both higher on the day. It shows you there's a little bit of a risk-off tone in commodities to match the risk-off or risk-on tone, that you're seeing in futures and in yields as well, Kailey.
Well, you talked about how the big tech earnings are feeding through on the macro kind of larger scale picture. Let's look at the individual moves, though, before the bell, Kriti. Of course, Microsoft was the one who performed better after the bell yesterday, really thanks to cloud growth. That in particular really what driving the beats for the company. That stock is up 5.5% as a result of that. But of course, different story for Alphabet. Kriti was talking about the weakness in European ad sales. You also had weakness for YouTube. Part of that is the fact that all the young kids are on TikTok, and that is eating to YouTube. But then also, of course, you had those Apple privacy rule changes, which make it harder to target advertising. So Alphabet is down about 2.5%. And of course, all of those headwinds on the advertising front don't bode well for other advertising-reliant social media companies. The likes of Meta, the parent company of Facebook, which we'll be reporting after the bell today. It's down 2% in early hours ahead of that. And of course, Twitter will be reporting tomorrow, Anna, but we continue to monitor not just the earnings story, but the fact that there will be no conference call because Elon Musk is buying the company for $54.20 a share. It is trading pretty significantly below that, about $5 below that this morning, right around 49 before the bell, Anna.
Yeah, perhaps a little bit of execution risk still being priced in there on that price. Let us focus on what's going on here in Europe then. And European equity markets recovering from some of their earlier nervousness. We saw selling in the early part of the trading day, very much associated with what we'd heard from Russia. Russia confirming this morning they'd cut off those gas supplies to Poland and to Bulgaria. And that raises the question of where in Europe is next. We've heard from Russia this morning talking about payment for gas. More on that in a moment. European natural gas prices then had jumped on that news, up by 20% at the start of trade. They were up by 11% in yesterday's session. So moving back towards those elevated levels that we saw last year. We've paired those gains now a little bit, but it still remains a real focus for European investors. Mercedes-Benz, back to the earnings story, that stock up by more than 3%. And this company really focusing on their ability to price. They were talking about what's going on in pricing power and the way that they can pivot towards more expensive vehicles, essentially. And Deutsche Bank down by 6% this morning on the back of their numbers and the focus on costs. On the Russian asset front, this is what we see on the Russian ruble right now. And we have heard from Russia that they want, of course, to see payments for gas in rubles. And that's where all the tension lies around this gas story, Kailey. The Europeans still don't want to, although we heard from Russia this morning that 4 European energy companies have apparently, according to the Russians at least, we'll look for confirmation of this, have paid in rubles.
Yep, a story we will continue to monitor. Just as, Anna, here in the United States, we will continue to monitor big tech earnings. Of course, you had Alphabet and Microsoft, as I said, both reporting after the bell yesterday with mixed results. But there's going to be more coming up. We have Meta that will report after the bell today. Twitter's coming tomorrow, as well as the likes of Amazon and Apple, the other huge heavyweights within this market. Joining us now to discuss is Rob Kniaz, a founding partner at Hoxton Ventures. He also is a former Google product manager. So, Rob, let's start with Google and these advertising headwinds that Alphabet is facing, not just when it comes to Google search, YouTube as well. What is your reaction?
No, it's pretty disappointing. I think if you think about the pie of online ad spending, it's clear that TikTok is taking a bigger and bigger piece of that pie now every quarter, and Google is seeing it in the earnings. I mean, it was disappointing to see YouTube, come in below expectations. That was quite a big surprise given the overall, importance of YouTube. But I think they're getting hit on all angles. They're getting hit with European and U.S. inflation numbers, where consumers are perhaps spending less and driving ad yields down. It's not a great place to be right now.
Okay, good to see you, Rob. Can I ask you about what we learned from the Alphabet story, what we learned from the Microsoft story, that could be instrumental in thinking about Alphabet and Google? One of our colleagues making the point that Microsoft really, shining on cloud and just highlighting how little advancements we've seen from Google on that front.
Yeah, I mean, it's just a tale of two stories. I think Microsoft is hit on all cylinders. If you look at every part of the business, it met or exceeded targets, and cloud is performing really well for them. Google, is hanging on and is still growing, albeit slower than they would like. I think Google is still committed to that, very long term. So you're going to see them continuing to invest in cloud and, fight their way in. But for now, it's Microsoft and Amazon that really have the lead, and Google's still third place and trying to catch up with not much success so far. You'll see they also announced they're increasing R&D spending by $1 billion. So, to me, that's, continuing to double down on the product and double down on the work. But they still haven't gotten the sales up to the level the level their peers are at.
Rob, it's that doubling down that I really want to emphasize here. Both Alphabet, both Microsoft, boasting quite a bit of cash on their balance sheets. Where should they be spending that money to really ensure that they can be competitive in, say, the next 5, next 10 years?
Yeah, I think like with everything in tech, it's R&D. R&D is what really matters and makes these platforms more differentiated. Right now, they're all fairly commoditized to an extent among the enterprise cloud products. But I think Google's making the right move with a $1 billion increase in R&D. Microsoft and Amazon both are doing the same. And then Google's, of course, doing a large buyback, which again shows maybe less confidence on the long-term advertising markets or the near-term advertising markets. So the buyback is interesting that it's such a big buyback, $70 billion. But it is reassuring to hear $1 billion more on R&D, that they are thinking about the right innovations that'll drive the growth.
Yeah, on the point of buybacks, Rob, one of our analysts here at Bloomberg Intelligence told me yesterday that's kind of, other than R&D, the only really place they can put cash to work, because acquisitions are very, very hard in this regulatory environment here in the U.S. While we're talking about how flush with cash these companies are, though, how recession resistant are they? What are we learning about the business models, where their revenue reliance is, like on the advertising front, for example, as we also talk about a slowing global economy?
Yeah, I mean, I think, if you look at their composition of customers, Microsoft is clearly far more exposed to business than consumer. Google's a bit more mixed between consumer and B2B both, and clearly Google's trying to double down on the B2B side of things. So I think in a recessionary environment, clearly consumer spending is often a leading indicator. So that's where Google and Meta and the others will be potentially hit first. Microsoft, again, at some point, if we do go into a recession, business spending will go down. The question is, how much of that spending is able to be taken down once you've moved your business into the cloud, or once you moved your products into Azure or Google Cloud, it's a bit hard to take your spending down. So I think, in a tougher environment, people do have enough reliance on their technology. They don't really have room to cut what they spend on the cloud. So people will try and economize, but I think these businesses will probably all outperform.
Do you get any clues, Rob, so far on the state of the US consumer, or would that be to read too much into some of these tech earnings? People ask themselves that question after Netflix, but maybe it was something very much more about competition from other players in the real world going on there. But what do you see in terms of the US consumer?
I mean, I think things are fairly flat from what we've seen in the numbers that we look at. I think there's still a lot of questions around the economy and how will it perform later this year. And I think the ad dollars right now is simply a fact that the pie is staying about what it is. That pie is not growing too much, so people are fighting over different shares of the pie, and that's where TikTok entering the picture really starts to cut into YouTube, because that's a one-to-one competitor. And if you're allocating ad spend, you're increasingly putting money toward TikTok that you otherwise might have put in YouTube. So I think it's win or loser, and in that case, Meta and Google are probably the ones that are hurt more by TikTok directly.
Rob, thanks very much for joining us. Rob Kniaz, founding partner at Hoxton Ventures, giving us his thoughts on tech. Coming up, Freya Beamish, head of macro research at TS Lombard. What does she make of tech? What does she think about what we're seeing in China and the growth story there? This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, General Motors Chair and CEO Mary Barra. That's at 8:45 a.m. in New York, 1:45 p.m. in London. This is Bloomberg.
For the economy, there are other effects out there. Of course, the supply chain disruptions, the lingering effects of COVID, including lockdowns in China, and naturally high energy prices that actually existed prior to the war effects. All of those, I think, are having an impact on the economy and business confidence. And we also stand in front of what will be a relatively historic rate rise cycle that's beginning in the United States.
That was the Deutsche Bank CFO, James von Moltke, speaking earlier on Bloomberg about threats to the global economy. Let's pick up on that theme with Freya Beamish, head of macro research at TS Lombard. And Freya, the threat to the global economy that jumps out to us from the news flow this morning is all around Europe, and the threat from Russia to stop sending, or the reality that they've stopped sending gas to Poland and to Bulgaria. And now people ask, well, where will that go next? What kind of downside to the European economy would we see if we did see Russia stop sending gas?
Well, I think what we did was to take quite a simple approach, was just to do a series of kind of back-of-the-envelope calculations and realize that overall, so far, the hit to growth is probably about 5% of GDP, and the mitigating factors are probably about 2.5%. So while we start at the beginning of the year in the high threes for growth, we're now in the low twos, which is the so-called worst-case scenario currently for the ECB, but that looks like almost the top end of our range. And it's really a factor of something bad has happened, and it's stagflationary, and the ECB can fight against that for a while, but in the end, it is inflation, which is cost-push inflation, which destroys demand. And we think they through the middle of the year, will fight against it and try and stay on that hawkish bandwagon and avoid further euro depreciation, which embeds inflation, which is what they really don't want. But growth is just not going to hold up. And by the time we get to Q4, that'll be clear.
So a situation, as I outlined, Freya, could lead to rationing of energy products around Europe. You still see a situation where that would allow there to be growth in the Eurozone, though?
So the 2% this year implies 0% quarter on quarter all the way through the year. There's a massive carryover effect in the year on year terms, full year on year terms this year, just because of the craziness of the base effects. So we actually think that there might not be a technical recession, but there could be negative quarters of growth. Q2 is going to be very weak globally. And Q4 is going to be very weak in the euro area as well. And maybe you get some positive quarter coming through in Q3 just because of release of pent-up demand. But that all kind of is before you even factor in the slowdown in China, which could become a much more serious thing.
Okay, Freya, well, let's talk about China. You had Xi Jinping overnight talking up infrastructure spending, really trying to bolster the economy. How much can that work if COVID-0 is still the policy?
Yeah, it's very difficult for China to get growth this year, largely because China doesn't grow unless there's a further greater liquidity growth. And there's a 3-quarter lag between that liquidity growth picking up and nominal GDP actually picking up. So the trend in nominal GDP growth is not going to pick up until around the end of this year, but unfortunately the deflator is still going higher. And so when you clock up all the numbers together, it's very hard to get growth in reality above kind of 4%, probably 3%, and depending on how much of the infrastructure they're successful in pumping out, then it could be even lower than that at points. So it's clear why they are acting in this way and trying to bolster growth. And they'll never print below 5% because their target is around 5.5%. But the reality is going to be much weaker.
So Freya, what does that mean for fund flows, for capital flows in particular? If you start to see a lot of this weakening growth, as you point out, in China and potentially Europe and arguably the read-through into the United States as well, where does the money go? Does it come into the United States or does it stay in these regional hubs?
I think your point is a good one, because essentially when I talk about that 3-quarter lag, when liquidity growth does eventually pick up, there's nowhere for it to go in the domestic economy. It's seemingly for about 3 quarters. So you get these capital outflows, and that's exactly what happened in 2015. And we're looking at probably a similar situation for the renminbi now, except that China is much more leveraged and in a much more difficult position on a structural basis. So it probably does come to the US, and it probably does come to developed markets, because EMs are kind of caught in this pincer movement as well between the hiking of the Fed and the slowdown in China. But that also speaks to the kind of longer term trends that there is a deglobalization effect. And China, unfortunately, can't rely on the path that was taken by Japan and Korea when they kind of hit their debt wall, which was to effectively devalue and rely on demand from the rest of the world. China's simply too big to do that, and it's politically impossible for them to do that.
Well, one of the other concerns when it comes to China is simply how much they can continue to export in light of those COVID lockdowns, as Kailey mentioned before. But I'm curious what that means for the export picture and consequently the currency picture for some of these other major companies. Japanese exports, for example, can they ramp up in the face of a weakening yen? American exports in terms of making up the gap from Ukraine and Russia, even in the face of a strengthening dollar. Can you square the two for us?
I think, yeah, broadly speaking, we do see this kind of trend of reshoring because the renminbi is so overvalued and probably has been overvalued since as long as 2011, 2012. And actually, we did start to see evidence of that in terms of PPI, inflation going to deflation in 2012. And this is when you see the big ramp up in debt to GDP in China as well. And also in the US, we saw kind of structural changes coming through in terms of the labor share of income starting to rise again, which is an indication that there is overvaluation of labor in China. So we do see reshoring of the kind of high value added products to the US and the lower value added within the EM space, but again, bearing in mind that kind of globalization trend seems now to be reversing.
Freya, thank you so much. Thanks for your analysis. Freya Beamish there, head of macro research at TS Lombard. More early edition still ahead. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off today. Tom Keene, co-anchor of Bloomberg Surveillance, joins us now with his single best chart today. Tom, what do you got?
The single best chart, it's the ugliest chart out there, Kriti. It's the one with too many lines, too many colors. I do this once every 90 days. Here it is, folks. This is from the pandemic beginning and the big mega caps. Apple in red, how cute. Microsoft in blue, Amazon in that ugly orange. And Google, I threw in yellow. SPX is in white. And on the chart here, it's a jumble. But what it says is a stark outperformance of Apple The others, particularly Amazon, challenged, but you know what? They've outperformed the Standard & Poor's 500.
Yeah, all tech not created equal then, Tom, and we're dissecting the tech sector this week. Who have you got appearing on your show to help you do that?
We've got a number of people. John Farrow will be with us today to talk about the euro. We're looking forward to talking to Mr. Farrow about a euro printing a 105. But very importantly, and timed for the gossip of Elon Musk, the engineer from Detroit, Mary Barra, will join us, and this will be a spirited conversation about the rule book she has to live with every day. I don't believe she's got a margin call due on General Motors shares, but we'll talk to her about all going on with GM and also the auto industry as Mr. Musk knows it.
Really looking forward to that one. GM definitely performing a little bit better than Tesla in recent days, Tom. Tom Keene, co-anchor of Bloomberg Surveillance, thank you very much. Now, in addition to that interview with Mary Barra, here's what else we're going to be watching today. I personally, talking of big tech, will be watching Meta results after the bell. Remember February when Meta reported, Creedy? It was really, really ugly because they gave such a weak sales forecast. And in hindsight, with the results we got from Alphabet, the talk of weak advertising trends when it comes to YouTube, when it comes to Europe, when it comes to those privacy changes on Apple devices, none of that spells good things for the parent company of Facebook. So it'll be interesting to see how long management says some of these headwinds they face will be with them. The stock is down about 2% in pre-market in anticipation of these results. Also, Creedy, I gotta be honest, I still need someone to really explain to me the vision for the metaverse because I'm just not there yet.
Yeah, I'm with you. But, you know, if you are Microsoft, for example, your vision of the metaverse is going to be working from home, the remote working as opposed to a social network. What's great about tech stocks is simply the idea that they're not dependent on things like inventories or supply chains as much as some of the other companies are. And that really brings me to what I'm watching. Wholesale inventories coming up at 8:30 a.m. this morning. Interesting to see how a lot of corporate America is positioned in the face of some of these supply chain issues. And I should say in the face of this potential Beijing lockdown, given the impact on simply exports coming out of China, Anna.
Does the metaverse mean the three of us all appearing, well, putting on headsets from wherever we are in the world and then sort of virtual us all present the show together? At least I could be in the same place as you in some sort of virtual existence. There we go. We'll try that one day. On more serious matters, I'm watching Russian gas and where it's heading and where it's not in particular, because we have seen such a step change in Russian policy toward Europe. The flow through the whole Ukraine war, the flow of gas had kept coming to Europe. And then we saw the Russians say they wanted it paid for in rubles and the Europeans don't want to pay for it in rubles. And so as a result, there is now this standoff. It's come to Poland and it's come to Bulgaria sooner. And that cutoff has already happened as of this morning. And the reason it's come to them is because their payments were due sooner. Poland and Bulgaria say they have taken action, in particular Poland, to try and insulate themselves from this. Their contract with Russia in the Polish case was coming to an end at the end of this year, but it really raises questions about where this goes next, about whether other parts of Europe, Kailey, are targeted in the same way. And there our attention goes to Germany and to Italy. And this could be something that once again will play into, well, the geopolitics of this, but then into inflation as well.
Absolutely. I mean, for Germany, they've been so reluctant to actually put an embargo on Russian fossil fuels because of the implications for the economy. The likes of the Bundesbank saying it will mean German growth retracts by 2% this year. But it's not necessarily Germany's choice entirely, Anna. If Russia does decide to cut off that gas flow, we're talking about a recession in all reality.
Yeah, absolutely, we could be. And that's what we were discussing with Freya Beamish a little bit earlier on, just how weak does the European growth story get if that is where we end up. We are not there yet, but certainly something we're monitoring. That is it for the early edition. Surveillance is ahead with Tom and John and Lisa. They'll be talking about the weakness in the euro that story has produced. This is Bloomberg.